Signs of the next big stock market crash. Hi everyone, welcome to CheckMate Millionaire. A stock market crash can be a scary thing. Right now, many people are in a catch-22 and they are not sure if they should invest now or wait. The big question on your mind right now, is there a looming stock market crash? I have good news for you. There are certain indicators that you can use to predict that a stock market crash is around the corner. If you see a large number of these warning signals flashing red, it can be a good time to lay low and avoid the damage that a stock market crash can cause. So today, we will have a look at the signs of the next big stock market crash. Make sure to watch all the way up to number 1, because you never know, it might be the one to help you avoid the shocks of a stock market crash. Also, make sure to subscribe to the channel so we can help you know more about investing in stock markets and other areas of investing. Just over a year ago, the COVID-19 crash brought a lot of uncertainty in the world events and put many investors on high alert, but right now the situation is much different. Widespread vaccination has given people hopes, and the housing prices are soaring high, and guess what? The stock market is also at all-time highs. On the other hand, there are some signs of a looming stock market meltdown. With the Feds printing more money and many analysts suggesting that the stock market is overvalued, I guess we should be on the lookout for the warning signals and protect our money. So let's have a look at the common precursors to a stock market crash and learn what steps you might take to avoid some of the damage. Number 10. Rising inflation. Although some might say that inflation is good for a country's economy since it allows businesses to slowly raise prices and generate profits, it can also translate into higher wages over time for the country's workers. However, rapid or sizable gains in the inflation rate can be a killer for the economy, and inflation scares can spook stock prices as well. When prices rise dramatically, the cost of operating a business rises as well. Not all of these increased costs can be passed along to consumers, resulting in reduced profits for businesses. Periods of rising inflation also tend to lead to higher Fed interest rates and tighter labor markets, further crimping corporate profits. Once business earnings are impaired, the familiar cycle kicks in. Reduced earnings leads to declines in share prices, potentially triggering a crash in the stock market. Number 9. Negative market sentiments. When investors perceive the financial markets well, it indicates a rising market. On the other hand, negative market sentiments by the investors show that a stock market crash is imminent. Several factors can affect how the investors perceive the financial markets. These include announcements by the Federal Reserve, presidential elections, and general geopolitical conditions. For instance, trends in the Consumer Price Index can be used to indicate future inflation. That can predict an increase in interest rates, which is generally bad for the stocks, and thus negative sentiment can be used to foretell a crash in the stock market. Number 8. Declining corporate earnings. Although stock prices are impacted on a second-to-second basis by several variables, over the long run, earnings are an important factor in supporting stock prices. Every quarter, companies report earnings, and the stock market reacts to them. When earnings start to decline across the board, it can be an indicator that an economic recession lies around the corner. In an environment of slowing or declining earnings, stock market valuations also shrink, triggering a reduction in market prices. When this contraction is severe and persists for long, it can cause a stock market crash. Number 7. Irrational exuberance. Irrational exuberance is a state of madness. In the stock market, this type of madness happens when investors are extra confident that the price of an asset will keep rising. This makes them lose sight of its real value. In such a state, investors become so greedy for profits and they end up overlooking the deteriorating value. The investors will get into a bidding war and push prices even higher. When more investors follow the herd mentality and invest in the asset, they create an asset bubble like the current one for Bitcoin. When the bubble eventually bursts, it sends everyone to panic, making them sell at any cost and ultimately causing a stock market crash. Number 6. Inverted yield curve. A yield curve refers to a plot of the yields on all treasury maturities, which is in simple terms a debt sold by the federal government, and it ranges from 1-month bills to 30-year treasury bonds. On the other hand, an inverted yield curve is one in which long-term interest rates are lower than short-term interest rates. This situation is considered inverted because typically longer-term loans involve higher risk and therefore carry higher yields. When long-term rates are lower, this indicates that investors feel the economy will be slower in the future and that rates will fall even lower. Thus, this is one of the indicators economists look at when they are predicting recessions. There was a lot of discussion about this event in 2019, as investors on both sides argued whether or not that event was the precursor of a recession. Historically, however, an inverted yield curve occurred before each recession of the last 50 years, with just a single false signal in that time. Thus, an inverted yield curve is a classic signal of a stock market crash. Number 5. Income inequality. Another sign of a possible financial meltdown is a continued problem of income inequality in the United States. This has been a problem for many decades already, but income inequality has increased since 1970. An analysis by the Brooklyn Institute shows that this wealth gap is wider now than at the start of the century. According to a paper by the Federal Reserve Bank of San Francisco, growing income inequality is a good precursor. The report demonstrated that years of rising income inequality and persistently low productivity growth also sowed the seeds for a crisis. Recessions tend to be more severe and slower in recovering when there are significant income inequalities. In fact, a 2019 article from the Washington Post mentions that the wealth concentration is once again returned to levels last seen during the Roaring '20s, which preceded the Great Depression. The economy for the average person is stuck within the economy. Over the last decade, many wealthy individuals have become super wealthy individuals. Many middle-class workers have this held around and at worst suffer significant declines in their liquid assets and spending power margin-to-debt ratio. Returning specifically back to Wall Street, the margin debt, the cash, or the gap between options and actual cash balances. It's exploding thanks in part to low rates. Margin debt balances hit an all-time high of $770 billion, nearly 37 times 21 billion investors held in March of 2000. To look at this another way, customer accounts are currently 72% more depth in cash. They're betting money that they don't have, and in many cases, they're incurring huge losses. Debt is what drove up stock prices, so that should give you an idea of how impactful it can be on current markets. It can infuse massive volatility into the markets and force government bailouts of corporate firms and things deemed too big to fail. Number 4. The Buffett Indicator. Warren Buffett is one of the most famous investors in the world, and he uses the Buffett Indicator to predict the stock market value. Buffett Indicator refers to the ratio of total U.S. stock market value divided by the GDP of the United States. The stock market value represents what is expected to be the value of the future economic activity, which is why expected earnings are such a big driver of the stock market. On the other hand, GDP measures current economic activity, so it captures all the value produced by the economy. So the ratio of these two metrics tells you the expected future economic growth relative to current economic growth. When this ratio is too high, Buffett deems stocks overvalued, as he did before the dot-com bubble of 2000 and the Great Recession of 2008. Currently, this indicator is at an all-time high, and Buffett's company itself is sitting on a pile of about $128 billion in cash. The Buffett Indicator, Warren Buffett's valuation metric, represents the total U.S. stock market value compared to annual gross domestic product. The current ratio is a market valuation of $42 trillion to a GDP of $21 trillion. Omaha's Oracle set the unprecedented highs we're seeing. The dot-com bubble burst should have been an indicator. To put this in perspective, the Buffett indicator for seeing the dot-com bubble popping was 139%. The current number is reading a high of 195%. Buffett had warned that anything close to 200% is an indicator of a stock market crash. So fellas, tighten your seatbelts, prepare for a potential crash. Number 3. A decline in credit quality. Generally, most countries run on credit. The United States economy is not different. All businesses, including small and large ones, run on credit. When there is an increase in credit, it means that the economy is growing and all is well. But this only happens as long as credit performance remains steady. A decline in loan performance is a definite precursor of trouble in the stock market. At the moment, credit card delinquencies have increased slightly to 2.59% after falling to a low of 2.12% in the first quarter of 2015. Also, the delinquency rate on installment loans, which include home equity, property improvement, mobile home, auto, recreational vehicle, marine, and personal loans, sits at just 1.78%, which is below the pre-recession average of 2.09%. Number 2. A decline in auto sales. Another great indicator of a growing economy is auto sales. Hence, when auto buyers reduce or slow the rate at which they purchase cars, this is an indication that it is either that they are financially down or have low confidence about making big purchases. Auto sales are one of the major purchases that people can make, and it is effective in showing how a country's domestic economy is doing as a whole. Thus, when such types of major purchases begin to slow, it may be reflecting a slowing economy, or in the worst case, a recession, which can cause a crash in the stock market. Number 1. Quantitative easing. Quantitative easing refers to a monetary policy where a central bank purchases government bonds or other financial assets to inject into the economy to expand economic activity. Quantitative easing has been largely undertaken by all major central banks worldwide following the global financial crisis of 2007 and 8, and definitely at a much higher level in response to the COVID-19 pandemic. This revived the economic engine, but when the pandemic persisted, the economy slowed. In fact, they were forced to inject even more money into the economy. So they continued to borrow from one person to pay another person, but the GDP isn't keeping pace. So we're borrowing money we don't even have in hopes of continuing and growing production. If this continues, our economy cannot be able to sustain itself for long, and so you should prepare for a stock market crash. Now that you've seen some of the possible signs of a stock market crash, what can you do if you notice any of these signs occurring? Let's preview some of the defense mechanisms that you can use to avoid big losses when we'll face the next big stock market crash. The first thing you need to do is diversify your investment. Don't invest all your money in the stock market. Consider investing in other areas like bonds and real estate funds, and also keeping some amounts in cash. This will ensure that you have assets that won't fail in case the stock market crashes. You can also try to cut down your stock holdings since some stocks are overvalued. So there you have it, great people. Do you agree with the signs that we've discussed here? Please let us know in the comments section. If you found this video helpful, please press the like button and subscribe to CheckMate Millionaire for more content like this.